Okay, imagine this. You start with, say, $10,000. And just 4 years later, that's turned into over $1 million. Sounds almost impossible, right? Like completely unrealistic. Well, our source material today suggests it happened, and it wasn't luck. It was apparently down to something called the LA's call options strategy. So today we're going to dive deep into that. We want to really unpack how this incredible growth was supposedly achieved.
Yeah, it's pretty fascinating. And the source really points to this LA strategy as the engine behind it all.
Right.
For anyone maybe not familiar, LABE stands for Long-Term Equity Anticipation Securities. Basically, they're options contracts, but the key difference is the expiration date. It's way out there, sometimes up to 2 years, maybe even a bit more. It really offers a different way to think about the market compared to short-term options.
Right, that long time frame sounds like a really big deal. The material talks about a trader who used this very shrewdly, but it wasn't about just like quick in and out trades, was it? How did they use these long-term things to get such extreme results?
Well, the core of it, based on what we've researched, seems to be a pretty disciplined approach. This trader focused specifically on long-term call options, and not just on any stocks, but high-growth tech names. Think Apple, Nvidia, those kinds of companies. But here's a crucial bit. They didn't just buy whenever. They deliberately bought when prices dipped.
Ah, okay. Buying the dip, we hear that a lot.
Exactly. But with options, it's maybe even more critical. It helps mitigate some of that initial risk, gives the trade some breathing room if the stock dips a little more before it recovers.
Okay, so timing the entry on a dip was part one, but you said specific call options. Were there other criteria, not just any LEP?
Right, good question. They specifically went for what are called deep in the money calls. That just means the options strike price, the price they have the right to buy at, was significantly below where the stock was actually trading at that moment.
Okay. And what's the advantage of doing that?
The big advantage is something called delta. Deep in the money calls have a delta close to 1, which, in simple terms, means the options price moves almost dollar for dollar with the actual stock price. So it behaves a lot like owning the stock itself, but, and this is key, for way less capital tied up at the start. Plus, with those 1 to 2 year expiration dates, they weren't sweating the daily ups and downs.
So it really wasn't about day trading or short-term moves at all then. It sounds more like positioning for the long haul, patience.
Precisely. Yeah,
Yeah.
patience is a good word for it. Instead of chasing quick profits, the whole idea was to hold these options while the underlying stock went through its major growth phases. This let them ride out the inevitable volatility, tech stocks can be, and capture the bigger, longer-term upward trend. It's almost counterintuitive in today's market where everyone seems focused on speed.
It really is. That patience aspect stands out. The source material also talks about the specific advantages that made this